Armanino's webinar today. We're really excited to present our CFO benchmark results, and this is actually part one of part two. We're going to be looking at data, trends, and tactics for the finance organization, and it's really great for us to be able to present what the CF community is really saying and then present our insights and recommendations. First, a little bit of housekeeping here. If you notice, you have an arrow on the right of your pane. You can minimize or maximize that at any time. Also, we want to be sure that you're hearing everything clearly. So if your system is coming out of the computer, your audio, you want to be able to click on mic and speakers. So for CE, many of you will want to get CE today, and so we need to go over those requirements, which means you need to be using a personal computer with your own information and unique URL. You need to be on the webinar for at least 50 consecutive minutes, and we'll be asking polling questions throughout the webinar. You need to answer 75% of those questions. And then you also need to complete the evaluation survey at the end. And even if you're not taking CE, we really would like you to complete so we know how we did. So let me go into the overview of today's presentation. We are going to cover the CFO Evolution Framework. We're going to go over the demographics so you have an idea of who took the survey. And then we're going to dive into three parts of the survey, which are on geographic expansion, M&A transactions, and IPO. These are all three areas that CFOs are very much concerned with in terms of growth areas for their company. Now, on February 5th, we will be presenting part two of this survey, and it's going to cover other topics that CFOs are quite interested in, which are reporting and analytics, mobility, a little bit of compliance, and project management. And what are we going to learn today? What are you going to really walk away with? Well, first we're going to talk about expansion around the globe and the top priorities of the CFO organization. We're going to look at top due diligence and post-transaction task for M&A. We're going to look at preparing for an IPO and then touch upon some of the technology required to make all of these successful. Now, before we get started in the actual presentation, we're going to do our first polling question. And we're interested in knowing what you, the audience, are most thinking your top priority is out of these topics of geographic expansion, IPO, mergers and acquisition transactions, or none of the above. Great, and we're giving it a little bit of time here. Most of you have voted. We'll give it a couple more seconds. And remember, you do need to complete 75% of these polling questions for CE. All right, we'll close out the poll and take a look at the results. So let's see. Today, and we're waiting for your results here. So you can see that geographic expansion and M&A are your highest top priorities, followed by IPO, and a few of you said none of the above. Okay, now I'm happy to introduce Matt Armanino, who is a partner and COO here at Armanino. He oversees our operations and the advisory services practice. His prior experience involves working for startups and large technology companies, and he has actually ran companies with market expansion into Europe and Asia, has personally worked on a lot of M&As for our firm as well as for clients, and regularly assists in IPO readiness process. So without further ado, here is Matt.
Well, thank you, Lori, and welcome everyone. It's nice to be here. I'm looking forward to discussing our annual survey results with you for about the next 45 minutes or so. Hopefully I won't cough into the microphone. I have a little bit of a cold, so I apologize in advance for that, but hopefully I won't have any issues as we go through the webinar today. I think a good place to probably start is, why do we complete these surveys at all? The CFO Evolution Survey each year allows us to do a few things. One, it allows us to keep our pulse on what's happening in the marketplace, to determine really what are your priorities, your plans, your initiatives for the year, which is obviously valuable information that we can then turn around and share with all of you. I know that each year CFOs tell me they really look forward to hearing about what's going on with other organizations. What are the best practices? What are other issues that people are dealing with, other companies are dealing with? And so hopefully you can benefit from that type of information today. That's really why we're here. The results of our survey focused, as Lori said, on the trends and tactics that CFOs are focused on to help get their companies to the next level, and ultimately to enhance the value of the CFO organization in the process. So with that, let's click to the next slide, and I think it's a good place to start. Lori mentioned the CFO Evolution Framework, and I like to start here and just take a minute to review it, because it's not only the basis for our survey, but it's really a framework that we use in our practice each and every day to work with the CFOs on how they can think about their organization at a high level, and ultimately how they can create a roadmap to where they want to go. In most cases, I will tell you, CFOs want to move forward and evolve their role within the organization, and get to a point in time where they're spending more time in leadership rather than being stuck kind of behind the green visor in the pure role of accountant. And that's really the premise behind this framework. We took all the various functions of the CFO organization, and as all of you know, that set of responsibility, functional responsibilities, has continued to grow over the years, well beyond the core accounting and finance organization, to include IT, in many cases legal, compliance, a lot of other areas. And so what we try to do is take a look at all those functions and break it down into three categories, three buckets, if you will: the role of accountant, the role of protector, and the role of business leader. For many years now, the survey has confirmed that the vast majority of organizations, regardless of size and industry, spend the majority of their collective time and bandwidth, not just the CFO himself or herself, but the whole CFO organization, kind of in the role of accountant, when in fact they would like to spend far more time in a business leadership role. This year, as we look at the survey results, CFOs said they spend 55% of their organizational time in the role of accountant, and they wish that could be reduced to about 30%. You know, conversely, they'd like to flip the model on its head. They spend about 25% of their time in business leadership activity. That's that forward-looking activity where the organization is partnering with the rest of the C-suite, the rest of the organization, the CEO and the board, to drive the business forward. Might be engaging in IPO support or M&A activity, strategic planning, business analytics, etc. But today, they really aren't there, and they'd like to spend more time. So why? Why is that? Why, if that's the desire of most organizations, why aren't CFOs making this transition more quickly? And I think, as all of you know, the answer, quite frankly, is that it's very difficult. To achieve the goal in the face of, you know, seemingly ever-increasing demands on financial reporting, compliance, new technical accounting requirements, CFOs have to identify ways unique to their organization where they can streamline that accounting function and free up more time and energy to partner with the rest of the business and really engage in more business leadership activities. That's what CEOs would like them to do. That's what boards would like them to do. But again, there's no silver bullet. There's no one-size-fits-all answer for all organizations. And what I think each and every one of us has to do within our own organizations is look at the levers that we have to work with, and that's people, our business processes, and technology that make our finance organizations run. That's our focus at Armanino in our practice. It's certainly one of the goals of the CFO Evolution Survey, is to identify some of those initiatives that are helpful and help you move forward with them. Okay, so without further ado, let's go to the first slide here and talk a little bit about the demographics of the survey. As you can see, about 92% of the participants are part of the CFO organization, and 65% of the respondents are CFOs. So I think this demonstrates that the survey really is a true voice of the CFO organization. There's a lot on the slide here, but one of the things it shows is that once again we had really solid participation from multiple different industries this year, with the largest being the technology sector. Okay, so let's go ahead and get started and jump into reviewing the actual results. As Lori mentioned, we're going to review how CFOs are thinking and reacting to 3 different growth strategies that you are likely dealing with or you will deal with at some point in time during your career. We're going to start by looking at the first portion of the survey that addresses geographic expansion. In our survey, geographic expansion was rated as a top priority of companies. 53% of CFOs indicated that their companies are planning to expand internationally. 26% of those are planning on doing it in the next 12 months. That's a lot. And it's also in line with last year's survey results, which showed 54% planning to expand internationally. So this is a key theme for organizations for sure. Many CEOs are thinking about the next business opportunity that might be across borders, and I think CFOs need to ensure that they're ready to build the infrastructure and support that growing demand. So with that in mind, let's go ahead and take a look at where businesses are moving and why. Give it a second for this next slide to pull up. When we look a little closer at where the expansion efforts are taking place, 33% of the survey respondents indicated that Asia was the top choice for a new area for geographic expansion. That's not that surprising. Asia is the fastest growing economic region in the world. Annual growth forecasted at more than 6% this year. JP Morgan forecasting a 30% surge in the value of M&As in Asia this year. So that was the first choice. The second was Europe, ranking second as the next most common expansion choice. 26% saying there's plans to expand to or within Europe. Again, Europe is a hub for roughly 20% of the world's imports and exports of goods and services. Europe offers very favorable legal systems that provide great protection for intellectual property and investment. And lastly, 16% of respondents said their focus is on expanding to South America. Again, like Asia, South America is a very rapidly growing market. It's a significant trading partner with the U.S. South America as a continent trades 4 times as much with the U.S. as it does with China, for example. Foreign direct investment into South America is highest in Brazil, followed by Venezuela, Peru, and then El Salvador. So for those of you that are not planning on expanding internationally, many of you are still looking at expansion domestically, here nationally. So let's go ahead and take a little bit deeper dive into what the survey told us about that. Okay, our survey results show that 49% of companies are planning to expand within the U.S. over the next 3 years. 37% of respondents stated that they have plans to expand to up to 5 new states during the next 3 years. So where are companies expanding to when it relates to the U.S.? Well, it varies. The decision to expand to different states is driven by a lot of different factors, including individual and business tax laws, cost of labor, better access to regional markets, manufacturing costs, to name just a few. According to Forbes, the top 5 states that businesses expanded to in 2013, and this was largely based on costs, labor supply, regulatory environments, current economic climate, and growth prospects, were Virginia, North Dakota, Utah, North Carolina, and Colorado. So many of you will be headed towards new regions. It's only a matter of time, and I think being leaders of the finance organization, the takeaway is you need to start thinking about building a scalable infrastructure that's going to allow you to support that geographic growth. So before we dive into that, I'm going to let Lori move on to our second polling question.
Yeah, this is our second polling question, and what we'd like you to do is to choose your top reasons for expanding nationally. So this is nationally, and you're welcome to pick more than one if you see a couple of those that are the top reasons. And we're going to give you some time to answer that question. Okay, we're going to give you a few more seconds here. You will want to jump on and answer for CE especially. So let's close it out now. So taking a look at the results, we see that, wow, sales opportunities is really the driving force for expansion, which makes sense as you all are growing. So that was by far the top choice. All right, back to you, Matt.
All right. Give it a second for the next slide to pull up here. As I mentioned right before the polling question, the key is to have a scalable infrastructure to be able to expand nationally or internationally. CFOs need to be prepared. The survey results showed that more than 75% of CFOs ranked the top areas of focus as it relates to expanding geographically as business planning and structuring, tax planning, and integrated technology solutions. Each of these categories includes specific concerns CFOs need to be prepared for, and so we'll dive a little bit deeper into that in the next few slides. All right. So let's start with the first two of those, business structuring and tax planning. The survey shows that when expanding internationally, CFOs are concerned with issues related to business structure, what type of entity structure should they create, and the tax issues that are often related to that. So understanding the risk and rewards associated with different business structure options and tax benefits is a key consideration. For example, for those of you that are talking about expanding based on the need for a new sales representation, if that's the case, you might be looking at opening a branch office or subsidiary. That might be in your best interest, and that has certain tax treatments associated with it. On the other hand, if you're looking to expand into a market for market awareness and don't need a salesperson on the ground, you potentially are considering a representative office, which, if registered properly in the local jurisdiction, usually won't trigger local taxation. So these are some of the considerations that come into play around business structure. Another key concern revolves around transfer pricing. For CFOs looking to avoid the double taxation that can occur from selling a product in one jurisdiction and manufacturing it in another, implementing strict transfer pricing policies to justify the intercompany prices to tax authorities is key. And these are the issues that our tax accountants and consultants deal with here on a regular basis. So whether you rely on internal experts or external experts, this is really one of those areas where you really want to make sure you have the right people giving you the right advice. Finally, survey respondents indicated that their focus on intellectual property structure and desire to take advantage of potential opportunities to reduce their effective tax rate through international tax planning is strong. So one way to possibly reduce a company's U.S. global effective tax rate is by considering an offshore or non-U.S. Intellectual property structure. While these types of tax planning strategies can be extremely beneficial, they do come with some complexity, with increased compliance requirements in the local jurisdiction, as well as increased IRS scrutiny. So again, the message here is to plan ahead and engage international tax experts to assist you. So let's go ahead and now take a look at the third of the three concerns, and that's integrated technology solutions. Give it just a second again for the slide to move forward here. Perfect. Here we go. Okay, so this slide shows how many organizations have their IT system architecture set up today, and that's with various discrete applications or proprietary technology systems that have been deployed in a standalone kind of point solution fashion. In general, this type of business application architecture runs the risk of having some inherent inefficiencies. That includes overly manual processes and workarounds, the need to export and import files daily, and specifically as it relates to businesses that are expanding geographically, the increased complexity with workflow, systems integration, and challenges that come with complex multi-entity or multi-currency issues, consolidations, become increasingly challenging with this sort of environment. In the end, the scenario leaves organizations, in many cases, with systems that work independently, don't synchronize, create data in departmental silos, and most importantly, systems that prevent them from responding quickly to expansion needs. In an ideal world, your systems would be tightly integrated and rationalized from a business process and workflow perspective. They would effectively serve to automate manual processes whenever it makes sense, and to enable organizational scalability, which is a key requirement when it comes to geographic expansion. So if we go to the next slide, this next slide is intended to depict a slightly different scenario where you have a more tightly integrated technology architecture. Here, having, in this example, a solid integration between your ERP, CRM, and inventory management solutions can allow the company to ensure there's a consistent and accurate data flow between systems, seamlessly bridging the gap, breaking those data silos I mentioned, and it results in time being saved. The time that was once spent on manual processes can now be used to continue to help support and grow the business and support the expansion. Offices can more quickly be folded in, data can quickly be shared between departments, you can enable better reporting and forecasting, allow for faster month-end and quarter-end close processes, all while incorporating new entities, dealing with the challenge of multiple currencies, as I mentioned before. So consolidating systems not only increases the accuracy of the company's financial data, but it also allows you to scale the finance organization and your company's future expansion goals. Okay.
Okay, great. We are going to now ask you the third polling question, which is, we want to know now personally from your systems, what percentage of your systems are integrated? Do you kind of consider it less than 25%, 26 to 50%, 51 to 75%, or more than 75%? So be sure to vote for that CE by clicking one of those answers, and we've got pretty good participation, so I'm going to close it out in a few seconds here. Okay, let's close it out and let's take a look at the results. So we look at the results and we see that 43% are less than 25% of their systems are integrated. So it really does look more like that slide one. 35% are between 26 and 50%, and you've got somewhere around 22% over 50% of their systems. Okay, back to Matt for the next topic.
Okay, and we've already had one question typed in about the slides going by fairly quickly, and certainly we're trying to cover a lot of ground here. That's the reason why we broke the survey results into two parts this year, because there's so much content. I would tell you two things. One, the slides will be posted on our website after today's presentation, so you can go to amllp.com and see them there. And likewise, there is a more detailed report that goes through our survey findings in more detail. So as we've just wrapped up the overview of geographic expansion, if you'd like more details on that topic, you can have a copy of our survey report. Okay, so shifting gears now, we're going to move on and discuss M&A transactions, which was the second of the three growth strategies that the survey looked into. All right, the next slide is just pulling up now. So during some point in time in your career, you most likely have already dealt with or will be involved with one side or the other of a merger or acquisition. According to our survey, 2/3 of CFOs said that they have been involved in an M&A transaction at some point in time already in their career, and over half of the CFOs anticipate being involved in additional M&A transactions during the next 3 years. If you take a look at the kind of broader market activity over the last year in the U.S., targeted M&A transactions were at their highest volume since 2008. Globally, M&A volume was up nearly 20%. M&A transactions in total exceeded $2 trillion in 2013. Some of the largest deals were fueled by cheap financing and other market factors, but a lot has been going on. And with this rise in activity comes added responsibility and risk for CFO organizations. So before we look into some of those risks, I don't know, Lori, or you have one more polling question. So we'll do one more polling question, and then we'll dive into some of the risks associated with M&A.
Yeah, so before we dive into the risks, we wanted to see what you all said about choosing the top reasons why M&A transactions fall apart. And you are welcome to pick more than one if you feel like there's some real big top priorities here. But we've got poor contract negotiations, poor due diligence efforts, poor market acceptance, lack of technology system integration, and lack of employee culture integration. So if you can pick kind of the top reasons why you think that M&A deals fall apart. We're going to give you some time to answer that. Okay, we're going to close the poll now and look at the results. Okay, so as we look at the results, we see that, gosh, the poor contract lack of employee culture integration was the top choice of why deals fall apart, followed by lack of technology system integration, and then poor due diligence. So interesting, as you look at kind of some of, when you think about the pre and post in this, and we're probably looking at lack of employee culture and integration as more of a post-transaction kind of opportunity. So here we'll go on and have Matt talk about kind of the risk involved.
Yeah, and I'm pleased to see people answered that, because integration issues, I agree, very often are the reasons why you run into problems with transactions working out, and they're often overlooked on the front end of a deal, and they're very, very real considerations. So speaking of deals and transactions that don't work out, this slide kind of points out the significant risk involved. First of all, I guess backing up, there's a lot of advantages and rewards that can come with M&A, including the ability to gain economies of scale in the business, adding competitive advantage, increasing market share, acquiring new talent. All of those things are very real, but according to research on the topic conducted by Harvard Business Review recently, they concluded that between 70 and 90% of all M&A deals fail to reach their stated financial goals and fail to increase shareholder value. That's an alarming statistic. I was surprised to see it that high. I think as leaders within the CFO organization, your role in the M&A process is critical. It's essential. When a CEO tells you that there's going to be an upcoming M&A deal, often the responsibility falls on the CFO organization to help fully vet that opportunity, to understand the areas of risk, to ensure that the organization is going to get the best ROI possible from the investment it makes in the process. At Arbanino, we regularly work with clients on M&A activity, and I can tell you from experience that a well-run, thorough due diligence process is critical. It's to avoiding those unforeseen pitfalls in a deal. I think that was 34% of you identified that, and it's certainly the case. So this is a topic we explored in a bit more detail in this year's survey on the next slide. Specifically, the survey sought to find out what are the top areas of focus for CFOs when it comes to conducting due diligence. Not surprisingly, the top areas of focus identified included quality of earnings analysis, accuracy of financial forecasting, and a deep look at historical financial statement analysis. But as you all identified in your answer, oftentimes the issues that can surface and the real gotchas can lie elsewhere. They're often less obvious. And you'll also see they're identified in our survey responses: tax compliance and liability issues. It may be sales and use tax liability. Technology issues, which can lead to significant unplanned costs during the transition, the integration activity. And as you all said, employee and cultural integration issues are very, very real. So the importance of pre-transaction due diligence, I don't think, can be overstated. And post-transaction integration is a topic that's critical as well, and what we will look into on the next slide. All right. The survey showed that 73% of respondents listed standardization of processes across business units post-transaction is an item that is just crucial to M&A transaction success, and I think that's rightfully so. Mastering process change is challenging even without M&A activity, but when you're trying to accomplish that post-transaction in a new organization, in many cases with limited resources, it is even more daunting. So that's why I think more than 50% of respondents also ranked proper resource allocation, training, and support as the next most critical task post-transaction. Finally, 40% of CFOs listed common technology systems as critical success factor, as a critical success factor. Again, in many cases, this is an area where CFOs need to rely on systems experts, either internal folks if they exist within the organization with the right skill sets and competencies, or perhaps in the form of external experts, especially those with a strong understanding of the finance organization. This is an area where bringing the right expertise to bear can help the organization define a common IT strategy and IT architecture for the combined organization and help minimize the burden of the other three top concerns, which are process, resources, and training. In the end, successful acquisitions often come down to having a solid integration strategy for the combined companies and having a strong technology partner that understands the business and the needs of the finance organization. So all of these things have to be part of the transaction plan. Okay, we're going to move on. Again, there's quite a bit more detail in the actual survey report. I'd encourage you to take a look at it as it relates to M&A activity, but now we're going to move on to initial public offerings, which is our third and final expansion strategy that the survey covered. Okay, so 2013 was a banner year for IPOs. According to the survey, 39% of technology company CFOs anticipated going public, and 20% of CFOs from other industries anticipate an IPO in their future. That's a significant number for sure. Looking at 2013 as a whole, we saw more than 220 companies go public, raising more than $59 billion. In Silicon Valley alone, there were 28 IPOs, with technology companies certainly taking the lead. More U.S. companies are going public and raising money in 2013, did raise money in 2013 since the dot-com boom went bust in 2000. And as we look ahead in 2014, many experts are expecting the IPO market to remain robust and continue to push forward, full steam ahead. Let's go ahead and take a look at the next slide, I think, which highlights a couple of important things that we all can agree on. One is that companies can't control everything as it relates to the timing for an IPO. Whether the IPO window is open or not is outside of our control. External market events can have a dramatic effect on market and investor sentiment. For example, the S&P downgrade of the United States credit rating, the fiscal cliff, Eurozone debt crisis are all examples of those types of activities. And while that's all true, what CFOs can control is their preparedness and for an IPO event, making sure that the organization is ready to go public, so when the timing is right, the organization can pull the trigger and make it happen seamlessly. The bottom line is an IPO is a transformational event. It certainly can change the lives and fortunes of its investors, the management team, employees, but proper planning and early planning, in our view, is key. If we go to the next slide, we'll talk about a few of the top concerns in the IPO process. All right. So we asked survey respondents about the top concerns as it relates to planning for an IPO, and the survey showed that more than 50% of CFOs listed presenting the financial story to investors during the roadshow and getting the right team members in place as a top concern. In addition, CFOs have the chief burden of preparing an IPO roadmap and a readiness plan to ensure that the company is ready, as I mentioned before. Some of the key issues involved there include, making sure that internal controls are in place and the plan for Sarbanes-Oxley compliance is there, making sure SEC reporting capability is in place, ensuring systems are in place to meet reporting requirements, making sure accurate forecasting capability exists, which is critical as a public company, upgrading or integrating technology systems, including analytical tools for business intelligence or dashboarding of key performance indicators, ensuring that a qualified audit committee is in place and the board is rounded out, and of course preparing the company for its first audit as a public company are all examples. In addition to preparing for the Form S-1 itself and going through that exercise. So there's an awful lot of activity that the CFO organization needs to quarterback and have as part of a comprehensive plan. And I think that's one of the takeaways from my standpoint, is that with many of our clients, we've seen the most successful IPOs come down to having a planning process that begins early, picking the right partners, the lawyers, bankers, CPAs. The supporting cast are going to be part of that extended IPO team. And I think part of the process for many companies is simply recognizing that one of the challenges is that the existing finance team has their day jobs to deal with, in addition to the whole host of new responsibilities and additional tasks for gearing up for the IPO. So part of it is taking inventory of internal resources, who's available to do what, where are their gaps, and how are they going to be filled with additional resources, maybe in a teaming or sort of co-sourcing fashion as part of the IPO process. Okay, we're going to move on. I think this is our last polling question, Lori. Oh, actually, I'm lying to you. There's two more polling questions, I think, so at least one more here. Go ahead, Lori.
Okay, so we're going to show that our survey showed that CFOs said that the roadshow was one of their top concerns, what you all answered in the survey. So we wanted to find out from you, our audience, to dive a little bit deeper and find out what's most important to a successful IPO roadshow. So one is meaningful and informative data. Two is utilizing media, having video and animated presentations. Three, finding the best presenters to tell that story. Four is really to highlight the value proposition to the market. And five is proper forecasting. Okay, we've given enough time. That's great. So let's look at the results. So this is truly a CFO audience because we've got our top answer is A, which is 40% of you, 45% of you said that highlighting the value proposition to the market was most important, followed by a close, meaningful, and informative data. So really, it really highlights all the, the data and analytics and how you're going to present that story. And like I said, the roadshow was at the height of most importance to CFOs. So great. So we're going to go back to the presentation and turn it back to Matt.
Okay, there was a question typed in about, what is best practice around timing to start the planning process for an IPO. And, the answer varies. We see a lot of different things. I mean, we've had many companies start the process 18 to 24 months in advance in terms of having a roadmap and a plan and setting expectations internally about what it's going to take. I think 12 to 18 months is terrific when companies really plan that far ahead. We certainly have seen companies go through a readiness process in a much shorter time period, 3 to 6 months, a quarter or two, and that is often more harried for sure. I think there's some inefficiencies and extra costs that may come into play if the planning starts too late in the process, but it can be done. It's a question of how much resource you can dedicate internally, how much you're willing to sort of spend on outside resources to help key tasks get done. But I think in general, I would say best practice is in that 12 to 24 month time frame to start an overall planning process, mapping out key activities, and then in a very rationalized fashion being able to get buy-in, dedicate resources, and execute on that plan. Okay, on to the next slide here. So as I mentioned prior to the polling question, acting public, acting like a public company before going public can really be, I think, a key to success. And it's a key component to that is getting your technology ready in advance of ever coming close to ringing the stock market opening bell. In fact, we asked CFOs to tell us where the most important technology solutions are in terms of having them in place and being ready to go public. And not surprisingly, this is actually for the second year in a row, the majority of respondents in the survey said that having a core ERP system that's scalable and having enhanced budgeting and forecasting capability really needs to be implemented prior to going public. In addition, we see that CFOs value having an equity accounting and administration solution, a solid CRM system for their service organization and Salesforce automation. And, one of the hot topics in the marketplace today, you hear a lot about, is enhanced business intelligence capabilities. The ability to do a dashboarding and self-service analytics to push more data out to the organization, to managers that can act on it and be more effective. Those are some of the other key areas that CFOs highlight as important to have in place prior to entering into the public arena. I think the bottom line is if an IPO is part of your future plans, again, preparing early, ensure that your systems are in place, that the systems that you have in place today are robust enough to ease that transition to life as a public company is there, and if not, to identify where changes and upgrades may need to happen. Okay, the next slide talks about another really important topic, and that is the team, having the right team in place. I think this is just as important as having the right technology solutions in place. According to our survey, CFOs said getting the right team in place is a top priority, and because the finance organization has to do more under stricter deadlines once public, it really becomes mission critical. You can see that the key positions above, controller, accounting managers, technical accountants, those are positions that make sense for most companies to hire internally. That's part of the core team that's going to need to be in place for most finance organizations, most accounting teams as a public entity. I think the tricky part comes into play for many companies, and we see this within our client base, is for other hires, SEC reporting managers. Do I have a person on staff that has SEC reporting experience? Is that a position I want to hire, or do I want to grow into it? Do I want to outsource or co-source that to someone to help us with SEC reporting shortly after going public? Similar questions for the internal audit function or a SOX compliance manager. Do I have that resource internally, or is it a resource that needs to be supported, again, in a co-sourcing fashion with outside experts, or is it better to outsource it completely, which we see more and more companies doing? similar questions for directors of tax experts in general. And those are areas I think that CFOs need to consider, whether you know, an outsourced relationship or an internal hiring approach. You know, what makes the most sense in general. So something to think about, part of that planning process early on. So I mentioned before, Armanino has helped many companies go public. In the last year, we had quite a few go public. There's a few logos here. Really a congratulations to the companies on this slide for very, very successful IPOs. We were pleased that 9 of the last 18 companies that went public in 2013 are ones that we worked with and helped support through the IPO process. So that was really nice.
And we're going to do our final polling question, which is an easy one. Are you finding the content of this webinar useful? Okay, we're going to give it a few more seconds here so everyone can vote and get that CE credit in there. All right, we'll go ahead and close it. And, well, we're happy to say that 98% of you, yes, are finding it helpful and 2% are not. So we'll have to get to that 2%. Okay, so we'll go back to Matt again.
Well, my apologies in advance for the 2%. And I think someone said we should have an option for somewhat. So in any event, I hope that some of the content from today has been helpful. As we go to the next slide, there's a couple things here. We're kind of winding down to the end of our time. One is there is a complete report, a survey that goes into more detail about the findings. Lori, maybe you can let people know where exactly they can get a copy of that.
Yeah,
report.
we can actually send everybody a PDF copy of it or a hard copy, but as Matt mentioned, it is a booklet that has a lot more detail, and you'll see what CFOs answered to more detail. Of course, in this presentation, we only went over the highlights, so that can be available via email.
Okay, and who should they email?
Yeah, I mean, I can email everybody out the
perfect.
report on the call.
All right. Thank you. Well, I guess I'd like to end the discussion today, as I always do, and bringing it back, tying it back to the CFO Evolution Framework, which really, as I said at the outset, is the basis for the annual survey. Our clients are constantly looking for ways to transform their organization, and there's a strong desire to get to that next level. It's different for each of you, but regardless of where you are in your own company's evolution, your own maturation, most of you want to get to the next level. There are challenges to make it happen. The challenges of streamlining the core accounting function, figuring out how to prioritize the right things to protect the organization, and freeing up time to reach out and partner more closely with CEOs and boards, the rest of the management team, lines of business, to support that future-looking, the forward-looking business leadership activities is really, really very key. I hope that the review of at least the first half of the CFO Evolution survey results are insightful to most of you, and I hope that they have a direct tie back to some aspect of your business, something that you're dealing with right now or that you're going to be dealing with in the next year. So with that, I'm going to turn it back over to Lori for a final few announcements, and then we will conclude.
Yeah, so just to give a little bit of a teaser on the next webinar, we're really jumping into reporting and analytics and looking at really the predictable analytics and how CFOs are wanting to not just look at historical data, but really move forward in analyzing and offering boards and CEOs more kind of insight to where decisions should be moving forward. So there is good data around that information and how CFOs really get to that point. You know, it's something that is really trending, and business intelligence is a very hot topic for many CFOs. And then we're also going to be diving into mobility and looking at just where are companies using mobile applications and how are they using it in their business. Where are CFOs particularly rolling it out and what kind of companies are doing that? We also take a look at something kind of near and dear to CFOs, which is just kind of straight project management. Are folks able to manage an IT project on time and on budget? And if they're not, what are the kind of barriers that are preventing them from getting those projects done on time? And then we're going to dive a little bit into compliance, some of the top issues that CFOs are concerned with, and with the ACA being one of the top concerns, and really what are CFOs doing to react to some of this new environment in compliance in terms of resources and time. So it's really going to be another set of good information to go ahead and participate at, and that will be on February 5th, and everybody on this call will be able to be emailed an invitation, so be sure to look for that about 3 weeks out from February 5th. And if you're really interested in it and want to type in your question area now, you can let me know, and we'll sign you up automatically. You don't even have to wait for the invite to come. Now, the last portion of your responsibility in this is to complete the survey that once you close out this webinar, it will automatically pop up. So we really want to thank you for spending this hour with us, and we will be sending out an email within about 3 days with your certificates of completion. Thanks so much, and we'll see you next time.
Yeah, thanks everybody.